Welcome to Chapter 7 in your Cornerstones textbook. In this chapter, we'll be talking about operating assets. These are the long-lived assets that you use for more than a year, that the company uses in their normal course of operations. Hence, they're called the operating assets. Now, we learn in the chapter that there are three major categories of operating assets. There's the property, plant, and equipment, which we sometimes call PP&E. Now, these are fixed assets. These are machinery, factories, land, things that tend to stay fixed, and they are tangible. Then we have a category called intangible assets. These are things like copyrights and patents. They're not necessarily things you can sort of wrap your arms around, but they are long-lived assets or assets with very long lives, more than 1 year, that are very important to the operations of a company. If you think about any record company, any publishing company, copyrights are extremely important. Any pharmaceutical company, any engineering company, any high-tech company, patents are very important. So they're very important, they're very valuable, and they're used daily in the operations of a company, but they are intangible. The last group of operating assets are natural resources. These are things like minerals or hydrocarbons like crude oil or natural gas, and even timberlands. Now, for an operating asset, when you purchase it, you record it at cost. And this satisfies the historical cost principle that we learned in an earlier chapter, which is something that's very important for GAAP accounting. Now, if you noticed, we say that we must record all costs. What are all the costs? All the costs might include more than just the purchase price of the asset. It might include, for instance, shipping, or maybe some installation costs, or some other things, all the costs required to make that asset useful. Now, what can we purchase an operating asset with? Well, we can buy it with cash. We could go into debt. We could get a loan or a note. Or we could exchange that asset for some other non-cash asset. So sometimes there could be an exchange of one machine for another or something like that. Now, for all operating assets, the costs are capitalized. What do we mean by capitalized? Well, what it means is, recall, operating assets have lives longer than 1 year. But we know that with most assets, anything of value, its value declines over time as you use it, as time goes on. It actually has less and less value, and we need to record that loss of value on a yearly basis, on an annual basis. So, for fixed assets, or property, plant, and equipment as we call it, the process of capitalizing the loss in value is called depreciation, and you've seen this before. For all intangible assets like copyrights, patents, the process of capitalizing the eventual loss in value is called amortization. Very, very similar process. We just use a different word when we're talking about the loss in value of intangible assets. And then for natural resources, this capitalization process is called depletion. For property, plant, and equipment, for fixed assets, if we want to think about all the costs, this graphic can give you a sense of what can be all the cost of purchasing land. Well, it can be the purchase price, of course, but there could be real estate commissions, delinquent property taxes. Remember, in the United States, the owning of property is something that is taxable, and sometimes the previous owner did not pay his or her taxes, and so the new owner has to pay the back taxes. So this graphic can provide you some good information on what other costs you might include in the total cost of a new operating asset. In addition, we might also include things, say if you buy a building, like the closing costs, which is what you pay the bank and some of the other lawyers and people involved in making the transaction happen. There might be architectural fees, there might be permit fees, there might be excavation costs. All of those would go into building costs. Same thing for equipment. One thing that sometimes people forget to put in is to include the cost of installation of new equipment, as well as the cost of any trial runs. That would be something you'd want to not forget. So once again, all the costs would be included in the total asset cost. So let's try an example. You've got a company here called Drew Company. Read about the new automatic milling machine they just purchased. Okay, so Drew bought $20,000 in cash and $80,000 in a 10% note. That's debt. Now, what does that make the total cost, purchase price rather, of this new automatic milling machine? Right, the total purchase price is now going to be the $20,000 in cash plus the $80,000 note, so it's a $100,000 purchase price. Is there any other costs included in the total cost of buying the new automatic milling machine? Right, they incurred freight charges on account, meaning they incurred an accounts payable of $2,900. They also paid a company named JB Contractors for installation, and they had to use $800 in supplies and $1,500 of labor on trial runs. So let's see if we can figure out the total cost of this machine. Remember, the machine cost is going to include all of the costs associated with making the machine usable for Drew Company. So that would be the purchase price, the freight cost, the installation cost, and the total cost of trial runs. Now, how did we figure out purchase price? Right, we said it was the $20,000 in cash plus the $80,000 value of the note, which is $100,000 for purchase price. We know that freight is $2,900, installation was $5,300 paid to JB Contractors, and the trial runs cost the total of supplies and labor, which is $800 plus $1,500, which gives us a total cost for this machine of $110,500. Now, what would the journal entry look like that we would need to use to record the purchase of the machine? Well, we have a new operating asset. So as of June 29th, 2011, we have this brand new operating asset. What account name would we use? Well, it's a machine. So I would choose of property, plant, or equipment, I would choose equipment. And what was the total asset value for this piece of equipment? Well, the total asset value, remember, asset value equals the total cost. And what was the total cost of this machine? Yeah, it was $110,500. Now, what were the various ways we paid for that $110,500? Well, we did pay some cash. What did we pay cash for? Right, the $20,000 in the purchase price was cash. Was there anything else paid for in cash? Well, because it doesn't say it was on account or on credit, we can assume that the $5,300 of installation was also cash. That means we credited cash for $25,300. What else did we need to do to pay for this equipment? Well, we signed a 1-year 10% note for $80,000, so I've got a notes payable of $80,000, right? What else? We paid for freight. And how did we pay for freight? Well, it was on account, remember? So that's going to be an accounts payable of $2,900, and we're going to credit accounts payable because that's a liability account. Note, both of these, accounts payable and notes payable, are both increases in liability accounts, so those are credits. And then we also used supplies. So we are going to credit our supplies account. Our supplies is an asset account, but we're using those supplies now, so we need to decrease it with an $800 credit. And we use labor, which is wages payable, another liability account for $1,500. So let's look at that in nice, neat typing. Equipment, debit, $110,500. Cash of $25,300. We put the rest of our credits in, and if you added all of these up, you would find that they total $110,500. That's how we account for a purchase. And notice, it included the total cost. That is, let me just remind you right here, when we made that debit to the equipment account, that's an asset account. That's a fixed asset account in the category of property, plant, and equipment. And so this just became what we call the book value, the book value of that automatic milling machine. On the date of purchase, its book value equaled the total cost. Now, we said that any property, plant, and equipment, we need to reduce the value over time, and we do that through a process of capitalization called depreciation. What does a journal entry look like for every annual depreciation entry? Well, we're going to debit depreciation expense. If you recall, there is an expense category on the income statement called depreciation expense. It is an expense category in the expense category, so we do debit it each year when we record depreciation. If you recall, this is a non-cash expense. We don't write checks to a man called depreciation or a company called depreciation, but it is an expense. It does reduce the total income for a company. We would also credit the accumulated depreciation account. Does everyone remember this one? What financial statement is that found on? Right, it's found on the balance sheet. And if you recall, it's a contra asset account. And whenever you see that little word contra, you know that it reduces the value of whatever comes after the hyphen. So in this case, an accumulated depreciation entry will reduce the value of some asset account. And in this case, if we are depreciating property, plant, and equipment, then accumulated depreciation will serve to reduce the book value of whatever property, plant, or equipment we are depreciating. That means on the assets of the balance sheet of that company, every year that they book some depreciation expense on the income statement, they are causing a reduction of their total asset value on their balance sheet because they enter a debit into depreciation expense and a credit to accumulated depreciation, which causes the total assets to be reduced for that year. Now, what do you need to know to be able to depreciate things? Well, you need to know the total cost of the asset. So it was any expenditure, as we just went over, that was needed to acquire the asset. We also need to know the useful life, sometimes called the expected life. In general, we don't expect machines or buildings to last forever, so there's some period of time over which we believe the asset will be useful. After that, we don't think it's terribly useful. And then we also may determine that there is a residual value. You may also see the term salvage value, and what that's referring to is whatever amount of cash or some other type of remuneration you believe you can receive for this asset at the end of its useful life. That means for some companies and some assets, it may have a useful life of 5 years, but it's still a little bit valuable at the end of it. But the company might say, well, at the end of that, we might sell it at the end of those 5 years. And so whatever amount we think we can get for that asset at the end of its useful life, we call the residual value. There are 3 methods we will cover in this chapter dealing with depreciation. There's the straight line method, and that says that there will be an equal amount of depreciation expense every single year. So whatever the useful life is of that asset, you should expect the same amount for depreciation expense every single year. Now we also, when we're using the straight line method, we can determine a straight line rate, which would say it's 1 divided by the useful life. So if an asset's useful life is 5 years, 1 divided by 5 is 0.2, or 20%. So what we would be saying is every single year of that asset's useful life, it would depreciate 20%. That's the straight line rate. Now the declining balance method is an accelerated depreciation method. It causes the asset to decline in value faster in the early years of its life. It uses some sort of multiple of that straight line rate, which is what we determine here. So if we were using the straight line method and we said the asset decreased in value 20% a year, in the declining balance method, if we said, hey, instead of 20% a year, let's double that. So it'll decline 40% a year. Well, that means, first of all, that you will not have the exact same amount of depreciation expense every year, right? Because it'll be faster in the early years, slower in the later years. But it also means that we have a little bit more calculating to do. Now, the units of production method is based on the asset usage. It doesn't have a useful life. It actually comes up with an amount of machine hours or number of milling units or number of pages or some sort of unit of production it says that it is useful for. So you come up with a depreciation cost per unit. Those are the three methods we'll cover. We will cover them in the next video. However, there is something extremely important we need to remember. All methods, all of the three depreciation methods we will cover, assume that the asset has some sort of residual value at the end. Now, it could be possible that we say it's zero, but we at least have to account for some sort of residual value. And the total depreciation expense over the asset's life must be the same. Now, in the double declining balance method, we know it's going to have more depreciation expense in the early years than the later years, but the total should still be the exact same amount. In the next video, we'll actually cover how to deal with these three methods.